Hello everyone, my classmates of Behavioral Finance and FinTech. My name is Kim Min-seok. It's so great to meet you on YouTube. This is my very first YouTube link and happy to have this opportunity to upload my YouTube video. The research paper that I picked to discuss with you is about mutual funds. Are you familiar with mutual funds? Mutual fund is professionally managed investment fund that pools money from many investors to purchase securities. And this paper gives a message through its title, which seems so interesting. Don't take their word for it. The misclassification of bond mutual funds. Firstly, I introduce the summary of the paper. Secondly, background, idea, and data. Thirdly, the results of tests. And finally, I'd like to talk what I liked or disliked regarding this paper and my suggestions as recommended by our Professor Andy Kim. This is the summary of this paper. Investors rely on external information if there is lack of information in the market. In U.S. mutual fund market, there are more than 5,000 funds and the number is growing. And especially in fixed income mutual fund market, though the SEC mandates equivalent disclosure of portfolio constituents for equity and bond mutual funds, the data are more complex in aggregated fund level, and because of this, information intermediaries provide a level of aggregation and summary information to bridge this gap, providing general riskiness, duration, and so on. And by using this information asymmetry, the bond fund managers' strategic misclassification of their holdings, investors are affected on their financial behavior. In this paper, the authors focused on the fixed income mutual fund market and picked Morningstar to compare fund profile provided by Morningstar to investors against the fund's actual portfolio holdings. And the authors found significant misclassification with up to 31.4%, and this misreporting has real effects on investors' behavior and mutual fund success. Misclassified funds charge significantly higher fees but receive higher flows from investors. From now on, I'd like to explain more detail about the background of this paper. As mentioned, there is more than 5,000 mutual funds in U.S. market, and SEC mandates disclosure of portfolio. However, SEC provided information is not enough, and data are more complex, especially in fixed income mutual fund market. And so, investors are looking for individual funds providing information to fill in the information gaps. To use this opportunity, financial intermediaries give strategic response, which is misreporting the aggregated funds information in a way they are in favor of. So, the authors focused in U.S. fixed income mutual fund market and tried to find out what kind of misreport is committed by intermediaries in this paper, especially in Morningstar. How Morningstar misreport. As I mentioned, the authors picked Morningstar and they tried to figure out how they misclassify and what is the effect on investors. Morningstar rates each fixed income mutual fund based on their assessment of credit quality and interest rate sensitivity in their so-called style box. And when they assess funds, Morningstar requires data provision from each fund, the percentage of funds' current holding bonds by risk ratings. AAA, AA, BBB, as you may heard. And the very point they adjust bond rating is here. Morningstar bases its credit risk summaries solely on the self-reported data. And the authors, through this paper, provide robust evidence that Morningstar funds, on average, report significantly safer portfolios than they actually hold. To give this evidence, the authors used data from Morningstar database, and also they assembled a collection of credit rating histories to document a substantial gap between the reported and true portfolio compositions in fixed income funds. From now on, I am gonna explain the results of tests. Firstly, the authors tested whether there is discrepancy in the actual fund reported percentage holdings minus the calculated percentage holdings by Morningstar. And the result shows discrepancy, most notably for assets above investment grades AAA, AAA. The percentage of assets reported by funds is markedly higher than the percentage of assets calculated by Morningstar. In histogram, you can also see discrepancies. If Morningstar and the bonds market reports same ratings, the histogram would show a sharp spike around zero, but there is wide discrepancies above investment grades and below the investment grades. Next, the authors examined the major implications of the difference between reported and actual compositions of fund portfolios. You can see the blue bar here. This is the distribution of the Morningstar assigned credit risk category of the fixed income funds. So, what mutual fund investors observe if they use Morningstar rates. Orange bar here is the fund's self-reported percentage of holdings in the various credit risk categories. And the gray bar here, this is calculated using the fund's actual holdings and their ratings. So you can see the discrepancies here. And the blue bar and the orange bar looks similar, right? So if Morningstar relies on the actual holding compositions of the funds, the blue bar should track the gray bar. But you can see here, the blue bar tracks the orange bar. So the half of the AA rated funds should have received the riskier BB like this lower graded categorization according to the actual holdings. But as you can see, these bonds are misclassified. In this section, they examined time series of fund observation from 2003 to 2018. As you can see, the number of misclassified funds increased dramatically over time, but mostly in 2010, the year Morningstar changed the way it calculated credit risk. Prior to this change, assets were weighted by assigning categorical scores that corresponded linearly to their credit ratings, like AAA 2 points, AA 3 points, A 4 points, like this. So it was linear, but from third quarter 2010, non-linear scores were applied, so portfolios become difficult to have high yield bonds while still maintaining a low credit risk classification. In this section, the author examined follow-up questions: whether these misclassified funds are in fact different from their risk category peers, given that they hold a larger percentage of lower credit quality assets than their risk category peers. And the result is all three yield columns for misclassified funds have significantly higher yields, as you can see here. And in column from 4 to 6, the authors explored how misclassified funds would if compared against their correctly classified risk peers. The result is misclassified dummy variables showed nearly zero and insignificant yield. This implies that when one properly accounts for the true risk of the fund's underlying holdings, they have identical, no difference yields as their true peer funds. And this is the similar but further tests to examine performance of misclassified funds against their correctly risk-classified peer funds. And the authors found out that the misclassified funds significantly outperform their risk style and Morningstar funds category peers, controlling for other determinants of returns. And here's a column from 3 to 4. They compared misclassified funds against their correctly classified peers, and they found that they exhibit no outperformance. And in fact, the misclassified funds actually slightly underperformed by 0.558 bps per month. For the next steps, the authors explored characteristics of misclassified funds. In the table 5, they found misclassified funds are associated with significantly higher levels of Morningstar stars. This is because Morningstar does not penalize fixed income funds for risk taken if the funds may bring higher returns in riskier position, leading to get higher Morningstar stars. In the table 6, they presented on average misclassified funds are associated with higher average annual expenses than funds within the same style category, which means that they are able to charge 10.8 higher fees than peers. In this table 7, they invested funds flows to misclassified funds, as Morningstar uses their star rating system to reward funds for true outperformance in their Morningstar category. And as previous literature analyzed there may have a strong relationship to investor funds flows. The authors examined the relationships, and as the table shows, the misclassified funds receive higher inflows, and this is consistent with investor types: institutional, retail, and retirement investors. The last test is about characteristics of those who misclassify, and the result is younger and larger funds, managers earlier in their careers, the more share classes a fund has. If the fund is the only taxable fixed income funds in the family, then there is tendency that the funds are misclassified. From now on, I'd like to share what I liked and disliked about the paper and why. Firstly, what I liked is how the authors set research subject and get data. As you know, setting research idea is difficult, and mostly the idea you may think you are the first one exploring an idea is already explored by others. However, the authors of this paper initiated novel research idea by narrowing down the research subject. The flows of idea and how the authors narrowed down their tested target was interesting for me. So, the flow is like this. There will be information gap in complex financial instrument, and to fill in the information gap, investors look for information provided by intermediaries, and the intermediaries will strategically misreport. And to prove this idea, they narrowed down the research subject to fixed income debt securities and picked one company, Morningstar. In addition, the progress of combining data was so novel. It seems that to test their hypothesis, the authors gave a lot of effort. If you read in section C, the authors explain the details, the progress to find out misclassification. Furthermore, whenever they meet obstacles in combining data, they set scenarios and did a lot of work to combine data set. For example, when multiple credit rating agencies rate a single asset, they aggregate using the Bloomberg or Barclays method as Morningstar's own methodology. They also used keyword search to rate AAA to treasuries and government-backed securities. To test their ideas, I felt that they tried to collect the precise data as possible as they can. What I disliked is the point that they only focus on Morningstar. When looking at the result, the Morningstar has changed their methodology in 2010, and from that time, the miscalculation number has significantly increased. It is likable suspicion that they found the problematic change in Morningstar first and generalized the result. And secondly, I feel they need to be careful when giving message that Morningstar misclassifying funds. They corrected the misclassification according to the traditional bond methodology, but we cannot say that traditional methodology is always right. In my thought, if there was explanation why Morningstar changed their methodology, it may be more helpful for readers to accepting author's message. I don't think that Morningstar changes their rating system to deceive riskier funds composition to be looked safer, and there may exist reasons of change, intentions what the star rating should be, and so on. I am very cautious to give suggestions to this great paper, but as Andy Kim, our professor, gave us it is mandatory, I should give my suggestions. For the theory part, if there is more article or literature review on misclassification's effects on investors' behavior, it may help readers understanding the relationship between Morningstar's misclassification and its effects on investors' behavior. Even though the author tested fund flows based on previous literature, more literature reviews are requested. For example, whether a small intermediary's misclassification also affects investors' behavior, or whether there is intermediary's motivation not to misclassify because of harmful effects on reputation and so on. For the empirical part, the authors investigate the difference between investor types and fund flows, and the results shows positive flows to misclassified funds from all types of investors. However, there is no explanation with degree of results of each investor types. For example, in the variable of average expenses, the result shows inconsistent pattern compared to other variables. In addition, according to the investor's type, information accessibility may be different, but the test shows only results without likable questions or explanations. So that's the end. Thank you for watching, and your comments and questions will be appreciated. Thank you.